Quantitative easing, or QE, is an unconventional monetary policy used by central banks to quickly increase the domestic money supply and spur economic activity. When short-term interest rates are either at or nearing zero, the normal operations of a central bank, which target interest rates, are no longer effective. Quantitative easing increases the money supply by purchasing longer-term securities or other government bonds from the open market. Buying these securities injects new money into the economy. A lower cost of money leads to lower interest rates. When interest rates are lower, banks can lend with easier terms. If QE itself loses effectiveness, a government's fiscal policy can be used to further expand the money supply. As an example, a government purchases long-term government bonds that are being issued to finance counter-cyclical deficit spending, a form of spending designed to counteract the economic cycle. Yet, there's still some risks involved. It can lead to a devalued domestic currency, or, as a worst-case scenario, a QE strategy could cause inflation without the intended economic growth. However, following the 2008 financial crisis, the Federal Reserve implemented a QE program that increased the Federal Reserve's balance sheet as it purchased bonds, mortgages, and other assets. And though it's hard to quantify, most economists believe the program helped rescue the U.S. economy.
The reversal of quantitative easing, or QE policies, implemented by a central bank. QE policies are intended to spur economic activity by increasing the domestic money supply. After an economy has been stimulated through quantitative easing, tapering is the first step in either winding down or withdrawing from this kind of monetary policy. Tapering reduces the rate at which a central bank buys assets. Tapering efforts are primarily aimed at interest rates and designed to control perceptions of the future rate directions. Continuing to stimulate an economy with stimulus money, sometimes called easy money, can lead to out-of-control inflation, asset price bubbles, and an overheated economy. So, when central banks stimulate an economy in a recession, they often promise to reverse their stimulus policies once the economy has recovered. Central banks typically employ a gradual taper rather than abruptly changing monetary policies. Central banks also usually outline their approach to tapering and the specific conditions that require it. By communicating openly with investors, central banks can help set expectations and reduce some market volatility. For example, in the case of QE, a central bank may announce its plans to slow asset purchases and sell off existing assets before doing so. This tapering helps reduce the number of total assets held by the central bank and, in turn, helps control the money supply. And by communicating policies in advance, central banks allow the market to begin making adjustments before the changes take place.